The recent crash of an Air India Boeing 787 en route to London, which claimed the lives of 242 passengers, has sent Boeing's shares plunging. This unfortunate accident is the most serious in its recent history, and once again highlights the quality problems of the American manufacturer, which more than 15 years ago decided to change its policy by prioritizing cost savings and shareholder remuneration via dividends over the quality of the final product. As a result, the European manufacturer Airbus has been able to overtake Boeing at the global level. Europe has achieved something that seemed impossible just a few decades ago, taking control of the global aerospace industry. In this video, we'll explore how Airbus became the world's largest manufacturer of commercial aircraft, the strategic mistakes that led to Boeing's decline, and what it all means for the future of the sector. Is this the end of the American aerospace giant, or could figures like Trump and his protectionist policies mean that they still have one last card to play? According to data from Cirium, a leading aviation analytics firm, there are currently around 25,000 aircraft flying worldwide. And here's the surprising part. Airbus, the European brand, dominates with nearly 14,000 planes in service. Boeing, the American giant that for decades symbolized US industrial supremacy, trails behind with 10,000 aircrafts. But this is something entirely new in aviation history. For 7 consecutive years, from 2012 to 2018, Boeing was the undisputed leader. In fact, the American company didn't just dominate in deliveries, its share price kept rising while boasting a generous dividend policy. However, everything changed dramatically from 2020 onwards. Airbus not only surpassed Boeing in total deliveries, but began winning on all fronts of the business. More worryingly, Boeing stopped posting profits, enduring 5 consecutive years of mounting losses. This historic turnaround wasn't a coincidence or down to a single cause. It's the result of 2 completely opposing business philosophies. Boeing focused on maximizing short-term profits and share buybacks. The American firm outsourced almost its entire production to the point where it only handled design and final inspection of its aircraft. Meanwhile, Airbus took the exact opposite approach, concentrating on controlling the quality of its products. In 2022, it consolidated its factories under Airbus Atlantic and set up Airbus Aerostructures in Germany to keep key components in-house. To put this change into perspective, a modern commercial aircraft costs between $90 million and $400 million. A single large order can be worth $25 billion in contracts. And here's where the story gets really interesting, because behind this shift in power are 3 critical decisions Boeing made that put its market dominance at risk. Boeing faces not 1 but 3 threats that could sink the American company for good. An unprecedented safety crisis, the impact of Trump's protectionist policies, and the rise of a new competitor from China. What led Boeing to make such disastrous decisions? It all started when management came up with an idea that seemed brilliant. Cut costs and maximize shareholder value. Well, nothing new there, right? What they didn't realize was they were about to prove that sometimes going cheap ends up costing a lot more. And to answer that question, you need to know that Boeing is now paying the price for a strategy that put dividends ahead of quality. Boeing's decline began in the mid-2000s when the company's leadership adopted a philosophy focused almost exclusively on 2 goals: cutting operational costs and maximizing short-term shareholder value. This approach, which prioritized immediate financial metrics over the excellence that had long defined the company, marked the start of a downward spiral. The clearest example of this strategy was the decision to sell its fuselage plants to supplier Spirit AeroSystems, effectively offloading one of the most critical components in aircraft manufacturing. But that was just the start of a systematic process that continued over the next decade, covering almost every aspect of aircraft construction and leaving Boeing essentially responsible only for design and final assembly. For a time, the plan seemed to work. By shedding manufacturing, Boeing drastically cut its capital and research investment. The savings created a capital surplus which, rather than being reinvested in product improvement or new technologies, was almost entirely used to reward shareholders. And the result of this? Boeing spent an astonishing $80 billion on share and buybacks and dividends, clearly prioritizing short-term shareholder value over the long-term sustainability of the business. Unsurprisingly, for a while, the stock price seemed to back this up, rising over 400% between 2010 and 2019, creating the illusion that the strategy was a success. So what went wrong? Essentially, Boeing's obsession with outsourcing production went so far that it lost control over its own aircraft. Literally. In January 2024, a door panel made by Spirit Aerosystems detached mid-flight from an Alaska Airlines 737 MAX 9. Imagine sitting by that window and suddenly part of the plane just disappears. Luckily, there were no casualties, but this was just the tip of the iceberg in a series of incidents that raised serious questions about Boeing's safety. Things got so bad that even US Secretary of State Antony Blinken had to cancel his official flight back from the Davos Forum due to an oxygen system leak on his Boeing aircraft. When even senior government officials can't trust your planes, you know you're in serious trouble. That's when airlines aware of these issues started cancelling Boeing orders, turning instead to Airbus. While Boeing was outsourcing everything it could, Airbus was doing the exact opposite. Thanks to its strict control, in 2022, Airbus integrated its factories under Airbus Atlantic and created Airbus Aerostructures in Germany, with the declared goal of retaining design authority and high-complexity manufacturing in-house. While Boeing was cutting back, Airbus was investing. And today, Airbus allocates over 4% of its revenue to R&D, around €3.9 billion just in 2024. Eventually, Boeing had a rethink and admitted its mistake. Just a few months ago, it launched a $4.7 billion offer to buy back Spirit Aerosystems and regain control of critical components. But this awakening may be too little too late, because while Boeing was trying to fix its mistakes, a second threat emerged: Donald Trump. And here's the biggest irony in this story. Trump imposed tariffs on European products, directly hitting Boeing suppliers. Yes, you heard that right. Remember, Boeing outsourced so much production that most of its suppliers are European, Canadian, and Japanese, all now subject to 25% tariffs on products like steel. Paradoxically, Boeing got caught in the crossfire of a trade war Trump started to protect American industry. The joke writes itself. To make matters worse, China retaliated against US restrictions on Nvidia chips by banning its local airlines from purchasing Boeing aircraft. It's true China only accounts for about 2% of Boeing's sales, which has led the company's leadership to announce plans to fill that gap by expanding in India and the Middle East. Meanwhile, Airbus, with its European production base, not only avoids these tariffs but continues to grow its orders. For every plane Boeing loses in China, Airbus sells 1.5. While Boeing battles with its suppliers and its own government's policies, a new rival is emerging on the horizon, one that barely a decade ago was taken as a joke. The third threat has a name: Comac, the Chinese aircraft manufacturer. Currently, there are around 190 Comac jets flying across Asia. That may seem small compared to the 25,000 commercial planes worldwide. But here's the number that should worry Boeing. Just last year, 10% of new planes delivered in Asia were Comacs. Only 15 years ago, the idea of a competitive Chinese commercial aircraft was laughed off in Seattle, Boeing's home turf. Today, Comac C919 is certified to fly not just in mainland China, but also in Indonesia, operating regular flights to Laos, Tajikistan, and Vietnam. The Asia-Pacific region accounts for 31% of the global fleet, with over 8,100 aircraft. It's the fastest growing market, and Boeing is being pushed out just when it needs to be strong. What if I told you the Comac C919 is basically an inspired by version of the Airbus A320neo? China is leveraging its massive domestic market to propel Comac, effectively forcing its national airlines to buy local planes. Projections suggest Comac could account for up to 25% of deliveries in Asia by 2030. And it holds a key advantage. While Boeing and Airbus have years-long waiting lists, Comac can deliver much faster. Boeing faces a perfect storm: a quality crisis, a trade war, and a hungry new competitor. With Boeing in freefall and Airbus dominating the market, the million-dollar question is, where should you put your money as an investor? If you had invested €10,000 in Airbus and Boeing 5 years ago, today one investment would be worth almost twice as much as the other. In a market with just two key players, should you bet on the dominant force or the fallen giant? Let's start by analysing Airbus, the new king of the skies. At first glance, buying shares near their all-time highs might seem a bit reckless. Or maybe not. The numbers speak for themselves. Airbus has steadily increased its operating revenue year after year, while its operating profit has remained stable at around €5 billion since 2022. The contrast couldn't be starker. Airbus posts consistent profits, whereas Boeing has racked up 5 consecutive years of growing losses. But it's not all perfect with the European giant. Its free cash flow was significantly negative in 2024. Is this the start of trouble or a hidden opportunity? The answer lies in where that money went. Airbus isn't splashing out recklessly, it's investing in its future. vertically integrating production with Airbus Atlantic and Airbus Aerostructures, and developing the ambitious zero-emissions hydrogen demonstrator. They're spending now to dominate sustainable aviation by 2035, a strategy completely opposite to Boeing's. From a technical perspective, recent pullbacks have brought the share price down to a strong support level around $123 per share, a level the market has tested repeatedly, proving its resilience. With a price-to-earnings ratio of 25 and a dividend policy that has improved by 20% since 2020, Airbus combines growth and value. Remember, we're not talking about some flashy startup, but the world's largest aircraft manufacturer. So what about Boeing? Is it a trap or the opportunity of the century? Well, Boeing has lost over half its value from its peak. Naturally, many contrarian investors ask, will the Trump administration allow a symbol of American industry to collapse? History is full of wounded giants that later became legendary investments. General Motors, after the 2008 crisis, is a perfect example. Moreover, Boeing seems to have seen the light. Its $4.7 billion offer to repurchase Spirit AeroSystems shows they recognize the mistake of excessive outsourcing. Plus, Boeing remains a giant in the defense market, where contracts are stable and lucrative. But let's be realistic. Investing in Boeing today is like betting on a boxer who's been knocked down 3 times to keep fighting. 5 consecutive years without profits isn't a coincidence, it's a clear trend. Boeing needs to solve fundamental issues before being considered a quality investment, not just a cheap one. Still, as usual, here's a middle ground solution. If you don't want to put all your eggs in one basket, diversification is always wise. Instead of betting on who builds the planes, why not invest in the whole ecosystem that uses them? This is where the next ETF comes in. The iShares Stocks Europe 600 Travel and Leisure UCITS ETF lets you invest in European tourism with a single trade, including airlines that buy from both Airbus and Boeing. This ETF comprises 14 companies, with the top 10 making up almost 89% of its weight. It also pays dividends up to 4 times a year, offering a 2% yield with a TER of 0.46%. In the last 5 years, it has risen by 40%. But what's more interesting is its structure of rising lows. Despite pandemics, terrorism, and economic crises, European tourism always bounces back. And right now, with the ETF having retracted to the 0.786 Fibonacci level, it could be the perfect time to get in before its next upward move. In short, Europe has taken control of the skies, and now you have 3 ways to benefit. Bet on the established leader Airbus, take a chance on a restructuring Boeing, or diversify with a European tourism ETF. The aviation industry is undergoing a historic shake-up that will create both winners and losers. While the Americans fight to regain lost ground, Europe is set to dominate the world's skies, at least for the coming decade. And by the way, if you want to discover more stocks worth considering, here's the latest version of our video featuring 7 high-potential shares to invest in for 2025, even in volatile times. And with that being said, that will be all for today. Make sure to hit the like button, subscribe to our channel for more content like this, and I will see you in the next video.